Hello everyone, welcome back to my channel. You probably heard of dollar cost averaging, DCA in short, being discussed by a lot of people. Some are even saying that DCA is the best investment technique or strategy. So in this video, I will be sharing with you what exactly is dollar cost averaging. So DCA is an investment technique of investing a fixed amount of money into a particular investment product at periodic intervals. Example, monthly or quarterly. For instance, investing a fixed amount into a particular stock over a period of 6 months. This means you will buy more units of the shares or unit trust when the price comes down and fewer units when the price is higher. First of all, let's take a look at what are the pros of dollar cost averaging. Dollar cost averaging prevents us from being emotional and help us stay invested. The last thing you need in investing is being emotional. Being emotional is example, when the stock prices go up, you are waiting for it to crash so that you can buy in. But the crash never happened and you end up holding onto the cash for long. Another scenario when investor gets emotional is panic sell the shares that he or she holds when the stock prices plunge due to external factors. If you are impulsive or emotional, you tend to lose the great opportunity, simply because no one can time the market perfectly. DCA allows you to invest regularly, ignoring all the external factors. Especially when the markets are going sideways, DCA is a disciplined, unemotional and balanced approach to get exposure to the stock markets without worrying too much. Pro number 2. As you are investing a small amount each time, the volatility risk could be mitigated, since you avoid putting all eggs in one basket at the same time. In the event of volatility and uncertainty, DCA can help to lessen the impact of drop in stock prices because when the stock price goes down, you are buying more shares. As you can see in the first table where DCA approach is used, the overall losses is much lesser than what you would be incurring if you were to invest your whole capital all at once. Okay, number 3. By adopting DCA, you can invest in small tranches over time. Hence, there is no reason for you to worry about whether do you have enough capital to start investing. This also allows you to be familiar with investing for the start, especially if you are a new investor. As a result, it also forces you to save regularly, which is a good finance habit. Number 4. DCA is a more practical choice among new investors and investors who may not have the time to actively monitor the performance of the stock market. It requires less time to monitor as the investing tool or platform that you could choose from are usually automatic and will help you to invest on a regular basis. You just have to sit back, look at your profits after a long period of time. However, you do probably need to spend some time to do your research and do your own due diligence to pick the investment product or stocks at the start. Everything comes with both pros and cons. One of the scenarios where DCA does not benefit your investment is when the markets are on a confirmed aggressive uptrend, which is usually the case when financial markets just recovered from a crisis. In DCA, the entry of capital is delayed, and when the price is increasing, you will end up buying lesser number of shares, and thereby missing out the full potential gains that you would have gained if you were to invest your whole capital all at once. Okay, so up to this point, you might think that, okay, it's very easy. I should just invest more capital when the price is lower. But again, no one can time the market. It's hard to predict if the share price is always on an uptrend. Sometimes this uptrend might not last for long. The second disadvantage point is DCA requires more transactions, resulting in more fees. Okay, most of the investment platforms charge a minimum transaction fees. Okay, in DCA, as the capital is injected in small tranches and higher frequency, this would result in higher transaction costs as compared to investing a larger sum of money each time. All in all, dollar cost averaging is a sound approach to adopt as an investment strategy as it takes the impulsiveness and guesswork out of the investing equation. In general, markets do go up over time and you will benefit from the long-term upside of staying invested. It's also potentially a more rewarding way to save from your monthly salary rather than keeping the money in cash. Most importantly, regardless of what investing strategy you use, be it investing in a lump sum or in small amounts regularly through dollar cost averaging, a lousy investment still remains as such. A right strategy used on a wrong stock will still result you in losing money. So fundamentally, you have to make sure you pick the right stock from the start. I hope you find this video useful. Remember to like and subscribe. I will see you in my next video. Bye!